Welcome students, welcome to Accountancy Point, where we study the accounting concept of standard 11 and 12. Welcome to each one of you on the very first day of lecture for class 11. The topic which we are going to begin today is the introduction to accounting, which is considered to be the very first chapter of accounting for standard 11. Children, accounting is a very vast subject. Actually, accountancy is the word which we use for this particular subject. Accountancy is the process of, it's a knowledge related to accounting. So, in today's lecture, first of all, before talking about anything regarding the accounting or accountancy, let us begin our discussion with the historical discussions on the accounting. How accounting has evolved throughout the world and how are we using it at present. Children, the evolution of accounting is from the time immemorial when the business, the trade started in the world. We have traces, in ancient times, we have the system which is called the barter system, which was prevalent, in which one person used to give goods to another person to take goods from the other. That means the exchange of goods with other goods was the barter system, and it was prevalent at the very beginning. Later on, this system of barter was replaced by hundis, that is the bills of exchange. It was used instead of money. People used to write in a piece of paper and they used to give it, hand it over to someone and used to take goods, and the payment was made later. The mode of payment used to be the goods itself, but in the future dates. Later on, when money became prevalent, the various forms of money we have. At the very beginning, we used money as the cowrie cells or the various grains and other means which were used as the money. Later on, the gold, silver, they were all used. The valuable, the precious metals were used as money. Later on, that was replaced by the when 2 or 3 metals were mixed and then the currency was produced, so that was used. After that, the paper money was used, like the money which we use in the form of 100 rupees, 500 rupees, that is the paper money. Now we have, after the paper money, we started using the plastic money in the form of cards, debit cards, credit cards. Now we are having the virtual money, that is e-money, in which we don't need the money actually, and we transfer from one bank to the other without actually handling the cash. So in all these various forms, these all forms kept on changing, and the mode of business also kept on changing. Traces of accounting records are evident nearly 7,000 years ago in the Mesopotamian civilization, when the trade links which we had with the Mesopotamian civilization, we have traces that they maintained business records, trade records in the various forms. Those records are still evident and the traces have been found of all those. During the 4th and 3rd millennium BC, witnessed the expansion of the role of accountants. During this period, the accountants, those who used to handle the trade records, their role increased. The priests, the leaders, they used to appoint the accountants and just to find out and to see the financial matters. The king, the other people, the priests, they give this power to the accountant to see the financial matters in those situations during these periods. During the 2nd millennium BC, the role of commerce in business increased. Now, what is commerce? The commerce is the trade means buying and selling and transportation, banking, all these situations when increased in business, that was the period when the importance of accountant had even increased more. In Egypt, we can understand the condition and the importance of the accountant, that in Egypt, one particular post was created for the accountants, and the name of that particular post was composral of the scribes. They were appointed to look after all the accountants in Egypt. 63 BC to AD 14, Roman government had complete access to detailed financial information. All the financial information were completely given to the Roman government during these centuries, these periods. As far as the evolution of accounting is concerned, we can talk in India that in India also it was practiced during Harappan and Indus Valley civilization. We have got the traces that the trades, the financial matters, the accounting records were maintained during these periods. Chanakya, who is considered to be the chief minister of Chandragupta Maurya, he had written a book. The name of the book was Arthashashtra. This is to be the only book, the authentic book in the world, the first book in India which was written for economics. And this particular book maintains the complete record on the accounting, accounting methods, how to record, and this is considered to be the authentic manuscripts in India for accounting. Children, after all these phases, whether in the world and India, we have categorized the entire accounting processes or the phases into three categories: first phase, second phase, and the third phase. First phase is attributed to the 15th century. Fra Luca Pacioli is considered to be the architect of double entry bookkeeping. If you come to the modern world, this first phase was started during the 15th century, where in the year 1494, Fra Luca Pacioli had written a book. And in that book, he had given a complete information about the present system of accounting, what we call double entry bookkeeping. So this particular concept was given by, first of all, by Fra Luca Pacioli, and in his book he was the first person to give symbols for plus and minus. He was the first one to use the symbols in a book, in a recorded first time in a book. He also used the concept of debit and credit for the first time in his own book. The second phase was that period when trade grew and the owner himself was unable to handle everything. So he appointed managers to look after his own business. And the owner used to exercise the control over these managers with the help of the accounting and reporting. The manager used to prepare the accounts, maintain the records, and on the basis of the accounting records, he used to prepare the report, and those reports were submitted to the owners. During the third phase, this phase is attributed to the development of joint stock companies from about 1600 AD. Now, due to this internal, this was the period when joint stock companies started coming into force. Means why? Because of the increase, because of the need of large capital, small business was unable to fulfill those requirements. So the joint stock company came into force, where the amount of investment grew in crores and crores and crores of rupees. And after that, the information, the accounting informations was to be utilized by the internal and the external users. Children, when joint stock company came into force, there were millions and millions of shareholders. All the people, those who had bought the shares of these companies, they all became the owners. and it was very difficult for them to come together to continue and run the business. That is why directors were appointed, who are called a group of directors, are known as board of directors. They were appointed to look after the business. The board of directors were assisted by a group of people called accountants, and those accountants maintained the business accounting records, and the reports were given to the board of directors, and those board of directors gave these reports to the shareholders and the various users of accounting. And that is why we say that the accounting information was to be utilized by the internal users and the external users of accounting. After that, in order to maintain a particular, uniformity, accounting standards were made in the country, in the world, and those accounting standards had to be followed by all the countries. Accounting standard, this is Accounting Standard Rules 2006, are notified under the Companies Act 2013 to be mandatory for all the companies. That means all the companies had to follow the accounting standard rules. In the year 2015, Indian Accounting Standard, it is written as IND-AS, that means Indian Accounting Standards were notified, which are equivalent to IFRS, International Financial Reporting System. So in this way, the accounting records and accounting data have grown over the years. Now we are going to discuss about three basic concepts, three basic terms which we frequently use in accounting, that is bookkeeping, accounting, and accountancy. Now we will see the various terms which we use in accountancy, which you will always come across. The first word is bookkeeping. What is bookkeeping? Bookkeeping is the art of recording business transactions. What are business transactions? Business transactions are all those transactions which happen in the normal course of business, like purchase, sale, you pay various types of expenses. So all these are the business transactions. Why do we need to record them? There is a need. Suppose, human memory is very limited. If you have got up early in the morning and you go to bed late at night. Now, after lying down on your bed at night, will you be able to recall all those things which you have done exactly in the same sequence throughout the day? Leave that. Just another example. Suppose I have a business. In every day, there are 100 of transactions take place. Will I be able to remember those 100 transactions every day? Leave about one day. I may remember. What about 30 days? In 30 days, 3000 transactions will be there. Will you be able to remember those 3000 transactions? In a year, 36,000 transactions will be there. Will you be able to remember those 36,000 transactions? What happened, when, and in what manner? What was the conditions? All these things cannot be remembered. So, in order to substitute the human memory, we, as soon as the transactions take place, we record them so that we will be using it whenever needed. This will be helpful in, first of all, substituting the human memory. They can be used as evidence in the court. They will be able to give you further details. You will be able to calculate profit or loss on the basis of these transactions. How? How will you record? In order to record, first of all, we are supposed to identify the financial transactions. What are the financial transactions? Financial transactions are those transactions which must have two characteristics, two features. First of all, it should be measurable in terms of money, and it should affect the financial condition of the business. Suppose I have bought goods. I already have a stock of goods of rupees 30,000 and I bought goods of 10,000 more. So what happened? My cash position reduced, my stock level increased, so the financial position of the business has changed. as well as stock which was purchased that was of worth rupees 10,000. That means they are expressed in monetary terms. So those transactions will be recorded using the rules of accounting. Now, children, what is accounting? Children, accounting is a wider term than bookkeeping. Bookkeeping is a smaller part. It is a part of accounting itself. So, in accounting, if you can see, the very first part is the same, recording. What will you record? Business transaction. Why? To substitute human memory. That means accounting, a part of accounting is bookkeeping. So bookkeeping is a smaller part and accounting is a larger part. It comprises bookkeeping, the very first step. Now the question is, if accounting also maintains the same thing, then what is the need of bookkeeping, or how is it different from them? Children, what happened that initially when business transactions were few, so we were satisfied only by recording those transactions. But after when the business transactions increased, it was very, very difficult for us to be satisfied only with the transactions. So some other features were also added. So when those features were added, they were termed as accounting. Now, besides bookkeeping, accounting also consists of classifying. What is classifying, children? Classifying is actually, you can see, it is organizing data. Suppose a simple example I would like to give you, that as I told you, I have a business and there are 100 transactions which take place every day. So in 1 month 3,000 and in 1 year 36,000 transactions have taken place. Suppose a person, Mr. Ramesh comes to me and says that give me 50,000 rupees which is due, which is balance. So before paying money to Mr. Ramesh, I will have to be sure that whether really I am supposed to pay 50,000 or not. So if I have maintained only the business records, what will happen? I will start checking the transactions right from the first transaction, and then all those 36,000 transactions will be checked. In between, if I forgot, once again I will restart. So for 4-5 days, Mr. Ramesh will wait at my place so that I will be calculating and finding the amount, and then I will pay him. So in order to save the time, what happens that as soon as the transactions take place, we record it in the books of accounts, and then all the similar data are written in one particular place. That gives us the classification. That is to get detailed information about similar data. After the data have been recorded at one particular, all similar data have been recorded at different places. With the help of that, will that be sufficient? Will that give me the information whether I am earning profit or not? No. So with the help of all these data, I will try to summarize my transactions. What is summarizing? Recording all revenues and all expenses. All my sources from where I have received the money, they will be written at one place. All my expenses will be shown at one place. And then I will see whether my revenue is more or expenses are more. If my revenue is more, I will have a profit. If my expenses will be more, I will be incurring losses. So summarizing is necessary to calculate net profit or net loss. And it also helps in the preparation of the financial statements called balance sheet, which gives me the detailed information about all my assets and all my liabilities on a particular date. After that, these data which I have calculated will be, just be satisfying for me that okay, I have earned a profit. But whether I will be using those data for my future use? How will I use those data so that in future I will be making more profit? Or if I have earned loss, how will I be able to convert those losses into profits? For that, interpretation and analysis is needed. So financial statements, those who are prepared balance sheet, they are interpreted to compare financial position of the business. You may compare your financial position with the previous year's financial position, or your financial position with some other organization's financial position. In this way, you will be able to find out where you stand in the market. And only that much is not sufficient. Now, as I told you children that today's is the world is joint stock company, where there is a large number of people, a large number of shareholders, large number of owners. So all of them must be informed. So these data have to be communicated. All these financial information needs to be communicated so that people will be able to take appropriate financial decisions. There was a company named HMT. You know, before HMT, it was making wristwatches. So before the company came to closure, 3 years before the company went for dissolution, the employees of those company had already started leaving the company. Why? Because, you know, knowing these data, knowing the financial position, they could understand that the company is not going to do well in the future. That is why they left. Similarly, you know, there are various users of accounting which we'll study just now. Next concept which we use is the accountancy. What is it? It is the systematic knowledge of accounting. That means how we will maintain all these things, how we will do all these things is a part of accountancy. And auditing is the process of checking whether accounting has been done as per the rule of accounting or not. Books have been, business transactions have been maintained as per the accounting rules or not. So that is auditing. So in short, you can say bookkeeping is the smallest, bigger than this is the accounting, bigger than this is the accountancy, and bigger than this is the auditing. Now, children, we will be talking about the various users of accounting. Now, children, as I told you, today's world is a situation where we are doing business on a very large scale. Multinational corporations are there. Thousands and lakhs and millions of people are there as the owners. And the employees are there. And there are various people, those who are associated with the organizations. So all these people need the accounting information. The question is why? Suppose children, if all of us as a business, suppose I have a business and I am maintaining my books of records according to my own convenience. So what will happen? If somebody else will come to check the books of accounts of mine, will he be able to understand? No. So there is a need there is a need that there must be an uniformity in all the methods by which I maintain the books of accounts. That is accounting standard and Indian accounting standard, IFRS, all those things have to be followed in order to bring the uniformity. Now suppose I have maintained the books of accounts. I have prepared trading account, profit and loss account and balance sheet. I have calculated the net profit. Those financial statements were compared with our own financial statements of previous year or some outsider, other business organization. And then we come to realize, we came to know about a lot many points, our strength, our weaknesses. So we made a report, and these reports have to be given to whom? What are these reports for? So these reports are useful for the various users of accounting. For our own convenience, we have segregated these users into two parts, internal as well as external users. Who are internal users? Internal users of accounting are those who are associated with the business organization from within the organization. In order to understand internal users, we can use these three letters. MIO. With these three letters, these three codes, you will be able to know about the internal users of accounting. M stands for management. That means the accounting records and data will be useful for management to decide, to make policies, to take decisions for the future in order to improve the condition of the organization. This E stands for employee. Who all are the employee? They are those people who are working for the organization. As I gave you the example of HMT. So these are the people who will be using these data and information in order to take their own decision and in order to decide whether they need more salary or they need more facilities from the organization or they should leave the organization. All these decisions can be taken by the employee. Last, O stands for the owners. Owners may be the shareholders, maybe the businessman himself, who will be able to take various decisions whether to invest in the business, withdraw the investment, or what all steps they can take. So these decisions can be taken. They are all related to the organization, from within the organization, and that is why they are known as internal users. Let us talk about the external users. Who are the external users? External users are those people, those who are not associated from within the organization, but they are associated from the organization from outside. In order to remember them, we have CBI, GRPC. These are the letters, these are the codes which you can use for the external users. You can use it as CBI government raid on any person. You can take the example of Priyanka Chopra. So CBI government raid on Priyanka Chopra. So C stands for creditors. Who are the creditors? Creditors are those who supply, who provide you financial help in case of any need. They supply you the raw materials and with the help of which you are able to do your business. B stands for, let's move to the I first. I stands for investors. G stands for government. R stands for researchers. B stands for banks. P stands for public. And C stands for customers. So children, these all are the external users who will be using these financial statements in order to derive the benefits for their own. Like banks will take the decision whether they will give you loan or not. Investors will decide whether they will make investment in your business or not. If your business is not doing well, with the help of the financial statements, they will be able to judge and they will be able to increase their investment or reduce their investment. Government will be able to decide how much tax to be taken, whether you have paid the tax of a previous year or a particular year, whether you have paid more or less. Researchers are those people who constantly judge and have watch on each and every business organization, and they are able to take further researches and developments. Public, they decide from these statements that whether the organization is doing welfare activities for them or not. And customers, last but not least, who are using the products of the organization. Children, now we will move on to the last concept, that is the accounting cycle. Children, here it is, the accounting cycle. What is accounting cycle? Accounting cycle is the process of following the various steps in the process of accounting. The process begins when the financial transactions are identified. As I told you, how will you identify? The identification of financial transaction depends upon two things. First, it should be measurable in terms of money. Second, it must affect the financial position of the business. When both these characteristics are present in any transaction, they will be recorded. Children, the recording of business transaction also comes from various types of the various books. These are called subsidiary books. When the business transactions increase, it becomes very difficult to maintain the records in a single book. So one single book is divided into many, subsidiary books, helping books, like cash book, which will record only the cash transaction. Purchase book, all the credit purchases will be recorded over here. Sales book, all the credit sales will be recorded over here. Purchase book, purchase return book, if there will be any goods which will be returned which you had purchased, sales return if you had sold and those goods are getting back to you, bills receivable book, bills payable book, and the transactions which do not come in any of these books will go to journal proper. So from there also transactions are recorded. The process of recording the transaction is known as journalizing or journal. From the journal, the transactions are classified and they are posted into ledger. If you remember in classification, I had told you that all similar data are brought at one place. So the book which contains all those separate accounts are known as ledger book. From ledger, they are summarized. In the summarizing, trial balance is prepared, and with the help of that, trading account, profit and loss account, and balance sheet are prepared. From there, the data are analyzed and interpreted, and then those interpreted data are communicated to various users of accounting. So this entire process keeps on circulating always, and it is known as accounting cycle. Hope this first lecture will help you a lot in understanding the concept. Please like, share, comment, and subscribe to the channel Accountancy Point. Thank you.